Shenzhen Hong Kong Stock Connect set for November launch. I think you have read in the news that the two exchanges, Shenzhen Stock Exchange and Hong Kong Stock Exchange, together with the two clearing companies, China Securities Depository and Clearing Corporation, and also Hong Kong Seekers, they have signed a cooperation agreement on 11th October. So this is formal. This has formalized the Stock Connect program. And next Monday, they will start the simulation test. It's important because they will, all along, it's just talk. Next Monday, the two exchanges will carry out simulation tests and running until November 9th. So by November 9th, all the systems after they should have completed the necessary simulation tests, and then it should be considered deemed as ready. So the exchange has also mentioned that if they set the launch date, it will probably be the Monday, the first trading day. That means they won't launch it on Tuesday, Wednesday, during the middle or the end of the week. They will start it, launch it at the beginning of the week. So it will be a Monday they will launch. So now they have not given decided on the date yet. But if the test ends on November 9th, so it's very likely that the launch date will be either 7 days from November 9th. I think it's the Monday. 7 days is 16th or 23rd. But it's very likely that it will be launched in November because everything will be ready by 9th, November 9th. So there should not be any delay after November. Okay. What are the rules of the game of this Shenzhen Hong Kong Stock Connect? How is it different from Shanghai Hong Kong Stock Connect? Actually, a lot of the requirements are the same. For instance, there is the eligible shares and also eligible investors. This one is new, is added for Shanghai Stock Connect. For foreign investors, all investors can buy the eligible shares. But for Shenzhen Hong Kong Stock Connect, for the Chinex, 创业板, because it's seen to be more risky. So only the professional, this northbound Shenzhen trading of company listed on the Chinex board, Shenzhen 的创业板, will be limited to institutional professional investors as defined in the relevant Hong Kong rules. So if you want to trade those stocks, I think Phillip Capital may need to ascertain your your investor status, whether you are in Singapore is called known as accredited investors. Hong Kong is professional investors, PI. So if you want to trade 创业板, you have to be a professional investors. But of course, they mentioned that subject to the resolution of related regulatory issues, other investors may subsequently be allowed to trade such shares. But whether you are now, I think better not touch it at the moment, because despite the sluggishness, 创业板, the PE is more than 90 times. Average PE of the Chinex is more than 90 times. So those are very high growth companies, and so that's why the market is giving a very high valuation. But of course, also it means it's more risky. It's riskier. And then other eligible shares include constituent stocks of the Shenzhen Component Index and Shenzhen Small Mid-Cap Innovation Index. They set a market cap minimum. They have to be at least with a market capitalization of 6 billion yuan or above that are eligible, because they don't want foreign investors to buy the small caps, the small capitalized companies with too small market capitalization, and it's seen to be more risky. Okay. And also the all Shenzhen listed shares of companies which have issued both A shares and H shares Under the Shanghai Hong Kong Stock Connect scheme, now it includes all the Shanghai listed A and H shares, but the Shenzhen listed A and H shares not included. This time around, under the Shenzhen Hong Kong Stock Connect, all the Shenzhen listed shares of companies which have A and H share listing will be included. I will show you a list. What are the around a dozen of companies are included. Okay. For southbound Hong Kong trading, that means for Chinese investors, they also are only allowed to trade certain eligible shares. What are the eligible shares? That will include the constituent stocks of the Hang Seng Composite Large Cap Index and also the Mid Cap Index. Actually, now is already included under Shanghai Hong Kong Stock Connect, so no different. The newly added is the small cap. This one is not included under Shanghai Hong Kong Stock Connect. So with the Shenzhen Hong Kong Stock Connect, Chinese investors also are able to buy small cap index, constituents of the Hang Seng Composite small cap index. But some companies, the market cap is below 5 billion yuan, Hong Kong dollars, 5 billion Hong Kong yuan dollars. So those are the smaller cap companies. So they want to eliminate those small cap companies. So they also set a minimum market capitalization of 5 billion Hong Kong dollars for those constituent stocks. So even if you are constituent stocks of the small cap, if your market capitalization is less than 5 billion Hong Kong dollars, you will not be eligible for the Stock Connect scheme. Okay. And also this is the same all SEHK listed shares of companies which have issued both A shares and H shares. Okay. Investment quota remains the same, but one thing they changed, they abolished the aggregate quota. Because when they launched the Shanghai Hong Kong Composite Index, they set two quota. One is the aggregate quota. The other one is the daily quota. Daily quota, that means every day you can buy up to net buying, net off. If the net buying reaches the maximum quota, there's no more buying that day. You have to wait the second day. And in the past, they also have an aggregate quota. The aggregate quota for Shanghai Hong Kong Stock Connect is 550 billion yuan. It's not too small also, but it's also not too big. But it caps the buying, the aggregate quota. But since they announced they're going to launch the Shenzhen Hong Kong Stock Connect, they also announced they abolished this aggregate quota. So I think the implication for Hong Kong and also for A shares is also there's a big implication. That means you can buy as much as you can in future. There's no aggregate quota, but they still want to control the daily quota in case too much buying happens every day. So like the tab, they control the daily run the tab, the running rate of the tab, but you can buy as much over a long period of time. You could buy as much as you wish to. So the quota will be the same. Daily quota will be the same for this one is not found. For foreign investors buying A share, the daily quota is higher, slightly higher, but set at 13 billion yuan. Southbound, the quota is 10.5 billion yuan. So another implication is that's good for Hong Kong is in the past for southbound money coming from China, every day they can only buy 10.5 billion. Now they can buy 2 times. It's double because under Shenzhen Stock Connect, there's another quota, daily quota of 10.5 billion. So that means if the Chinese investors get really very bullish, in the past, every day they can buy up to only 10.5 billion. Now it's 21 billion added up together. So it actually increased the scale of the investment that can come to Hong Kong going in future. And the investment quota may be adjusted by the parties in light of actual operation performance. And the aggregate quota under Shanghai Hong Kong Stock Connect is abolished. Okay, what is the investment universe? How big will it be for foreign investors? For your background information, the Shenzhen Exchange currently has 1,798 listed stocks, which include a lot of the innovative internet and technology companies, whereas the Shanghai Stock Exchange only has 1,177 listed stocks, which are primarily large cap state-owned enterprises. So people now, whether the response after the launch of the Shenzhen Hong Kong Stock Connect, whether the response will be better than the Shanghai Hong Kong Stock Connect, of course, remains to be seen. But at least we can see a key difference between the company listed. And we assume that foreign investors should be more interested in Shenzhen listed companies, because many of the companies are high growth stocks companies, high tech internet companies. The A-share Shanghai listed companies, most of them are big, the state-owned companies and the banks, the financials, so they can actually, for foreign investors, they can buy in Hong Kong cheaper A-shares. That's why under the Shanghai Hong Kong Stock Connect scheme, the northbound has not been too active. Northbound trade has not been too active. It's because the appeal of the A-shares to foreign investors is less. It should be less appealing compared to the Shanghai companies. Whether this assumption is true, we'll see after the launch. And after the launch of the Shenzhen Hong Kong Stock Connect, 417 Hong Kong stocks will be traded in Shenzhen, compared with the 318 Hong Kong stocks currently tradable by the Shanghai Hong Kong Stock Connect. So that means Chinese investors can trade more, about 100 more Hong Kong stocks, because now the mid-cap, large cap companies, constituents added up together 318. So with the small cap, another close to 199. Actually, 99 Hong Kong stocks are eligible for trading for the Chinese investors, 470 Hong Kong stocks. And then for global investors, they will be able to trade 880 Shenzhen listed stocks that are components of major global indexes. Actually, for foreign investors, they have a bigger investment universe. For Chinese investors, the investment universe is smaller, only for around 400 Hong Kong companies. But for foreign investors, around 880 Shenzhen listed stocks will be tradable for them. Okay. This is the list of all the Shenzhen listed companies with both A shares and S shares. So we can see that A share price quoted in renminbi and the H share price quoted in Hong Kong dollar. There's still some of the stocks, except the Weichai, but the stock code here is, sorry for a typo error, it should be 2338, not 2238, 2338. This is the only one that's trading almost nearly on par, very close. Other, you can see, wow, this Zhejiang Shibao A share trading at 42 yuan, Hong Kong H shares only trading at 11 Hong Kong dollars. That's 1/4 of the share price quoted on the Asia market. With this list on hand, but I will advise you not to just look at the premium. It doesn't mean that the higher the better. You buy the company with the highest premium, and then bet that the premium will narrow and you make profits. But it's the premium actually comes because the different perception of the different investors on both markets. Sometimes the Asian, I think the general belief is H share, the share price is more reliable, is more trustable because it's the share price is determined by the buyer, by the market. So the market, the H shares, because a lot of foreign institution players in Hong Kong, so the price they are willing to pay is more indicative of the actual value. But in China, sometimes they are irrational. Companies they're not making profits, no PE, they can still pay a high price. So don't just look at the premium, look at the fundamental. And then let's talk about, continue with the Stock Connect scheme. There's still other future development that we are expecting. It will not end there. Because the Stock Connect scheme is one way China gradually opens up its equities market. You know, China wants to open its equities market, wants to internationalize its equities market. But China is always very scared of opening up. So you see, for the renminbi, the currency, they still control it, but they gradually widen the trading band. It's a managed floating. China and the equities market as well. So they create a lot of strange things in China. What's the so-called QD, QFI, RQFI, and now the Stock Connect scheme. Why they created so many weird things? It's because they don't want to open up the market at one go. They want to gradually open the market. So they allow it step by step. Under the Stock Connect scheme, foreign investors are allowed to trade certain A shares. First is Shanghai, then is Shenzhen. And now only shares can be traded. ETFs are not included. So going forward, to further enrich the variety of traded products and provide more investment opportunities and convenience for domestic and overseas investors, the two regulators in China and Hong Kong have reached a consensus to include exchange-traded funds as eligible securities under the Mutual Market Access Scheme. A launch date will be announced separately after Shenzhen Hong Kong Stock Connect has been in operation for a period of time. So this will come next. The ETFs also will be included. And then this one I think is also a very important development. IPO Connect. That means for foreign investors, if they launch IPO Connect, they can participate in A-share IPO. Now you can, no way you can participate in the primary market, the IPO in China. But with IPO Connect, that means you can, through Hong Kong Exchange, participate in the subscribe to IPO listing in China. And vice versa, Chinese investors, now they cannot, unless they have an account in Hong Kong. Otherwise, if they don't have an account in Hong Kong, they cannot subscribe to IPOs in Hong Kong. But with IPO Connect, the conception is Chinese investors can also subscribe to Hong Kong IPOs. I think this is why I said this is important, because Hong Kong remained the world's #1 listing market in the first 9 months, and although total money raised in the stock market dropped 60% year on year, Hong Kong is still the world's #1 IPO market. So far, in the first 3 quarters, there were 40 offerings, IPO offerings in Hong Kong, amassing $16.92 billion, representing 22% of all listing funds raised worldwide. So Hong Kong raised 1/5 of the money in the world so far this year through IPOs. This beat the Shanghai Stock Exchange, $8.2 billion. You see, Shanghai ranked #2, but only half the amount raised through IPOs. And New York, the largest stock market in the world, only raised $7 billion and ranked #3. So Hong Kong, the IPO market, I think will remain very active, especially with the help of this IPO Connect. So more international companies, on the one hand, I think more international companies will be keen to get listing in Hong Kong because international companies, they want to tap the Chinese market for funds, for capital, but they cannot go direct to get a listing on the Asian market. So with IPO Connect, now they can indirectly 曲线的进入那个 A 股的市场，在香港上市，然后大陆的投资者可以通过这个新股通去认购这些国际公司。So in the past, Hong Kong, the Hong Kong EX, it has been criticized that Hong Kong is too dependent on Chinese companies for IPOs. 80-90% of the companies these IPO listings are from China. So once this dies out, or the supply of Chinese companies drops, then the Hong Kong IPO market will be adversely affected. But if in going forward, if more international companies are keen to get listed in Hong Kong because of the IPO Connect, so it will be positive to which stock would benefit most. Of course, it would be the Hong Kong EX. Hong Kong EX at the moment it enjoys more income revenue from the Stock Connect scheme because it will share with the other exchange under Shenzhen Hong Kong Stock Connect. All the trading and clearing fees arising from the Stock Connect will be shared equally between four parties, the two exchanges and also the two clearing houses, the two clearing companies. And because Hong Kong EX owns the clearing company in Hong Kong, the so-called CITIS, so that means it earns all the trading fees as well as the clearing fees. So for Hong Kong EX, it's one of the major beneficiaries of the Stock Connect scheme, more revenue, more income. And then it has also rolled out a 3-year strategic plan, which will include more connect schemes with commodities. Now, there's more, as I mentioned just now, China is still, the financial markets is still is close to international investors, the commodity exchanges as well. So they have this 3-year strategic plan. Gradually, they will launch the Commodity Connect, 商品通或者是期货通 because Hong Kong EX has acquired LME, London Metal Exchange, so it is in a very strong position to roll out commodities connect scheme to allow Chinese investors to trade LME products through their platform. So this is one of the competitive advantage that Hong Kong EX has. And also it is believed that, when they acquire LME, a lot of people said that, thought that Hong Kong EX was paying too high a price for buying LME. Just looking at the price itself, if there's no, further this connect scheme, commodities connect scheme, it may look pricey. But if the connect scheme is executed properly and it works out, it pays off, then the acquisition of LME becomes meaningful. Because for Hong Kong EX owning LME, wow, this is unlike other exchanges. The commodity, it will give it a very strong competitive edge by launching the Commodity Connect. Okay. And also now the Hong Kong EX is launching more yuan products. For instance, it has already launched the RMB currency futures. I think the trading will get more active over time because I mentioned just now is now the internationalization of the renminbi is getting picking up, especially after the renminbi has joined the SDR. It's become one of the SDR of the IMF. So we believe that there will be more demand for renminbi and also more trading interest on the derivative on renminbi derivatives. Okay, and Hong Kong Exchange is the only exchange in Hong Kong that can allow these currency futures. So it will benefit from launching more yuan products. Okay, but the share price is very volatile. You see, Hong Kong EX is a big cap company, also an index constituent. Yet it looks like a small cap stocks. Am I right? It looks like a penny stock. If you look at here, it can rally from below $180 to about $300 just within 1-2 months time. That was of course because of the big rally last year, triggered by the A-share market. And then of course Hong Kong, the turnover last year during the bull run increased very substantially. But after the market correction, it dropped to as low as 160, and now it's trending slightly. We are seeing an uptrend, although it's quite, it's not very steep, the uptrend. I think it's getting boost from Shanghai, Hong Kong Stock Connect. So our advice for Hong Kong EX trading is we believe it will trade between 180 and 220, 180 and 220, unless we see a bull market coming again, or the Shenzhen Hong Kong Stock Connect very successful, a strong response. We don't expect the share price to go up above 220. So 220 is more or less the cap upside. And then 180. So if it drops, now it's around 200. So it drops below, if it drops to 160 and 180, there's a definite buy. You can see in the last 2 years, it has never dropped below 160. The turnover itself, 160 seems to be the floor. So 160 to 180 is a very safe, buying level. 220 is a short-term resistance level. That if you hold, if there's no significant increase in the daily turnover, so by rising to 220, we advise taking profits. Okay. This is another stock that we would like to recommend. That's among the list of it's listed on the Shenzhen Stock Exchange with A share and X share. So this is a company with A share and X shares. And then the share price, of course, I'll show you the share price here. Chenming is here. Chenming, the closing price on 11 October, it closed at 920 yuan. And then X share trading at $7.38 Hong Kong dollar. So there's a premium of about, I think about 20 to 30% premium now. Okay. What does this company do? It's a company that manufactures and sells paper products, including machine-made paper, paperboard, and paper raw materials. So in terms of size and scale, actually it's comparable to 2 other big players also listed in Hong Kong that you may have heard about. Jiulong is one of the largest, and Li Wen, Zhaozi, 1814, 2314. But the difference is this is a state-owned enterprise. Actually, the full name of the company is Shandong Chenming. So it's actually owned by the Shandong municipal government. It's a state-owned enterprise. And the other 2 is private enterprise. But for a lot of the state-owned enterprise, actually they have a lot of resources and assets, but the profitability is very low. Unless they raise their efficiency, otherwise the investment value becomes not so attractive. But we notice this Chenming, you see the profitability, a sharp jump in profits last year from this is net profit. Actually, the turnover remains quite stable over the last 4 years, from 2012 to 2015, ranging from 19.6 billion yuan to 20 billion yuan. So over the last 4 years, it hovers around 20 billion yuan, the turnover. But the net profit increased from 505 million to more than 1 billion. So last year, its earnings doubled because of efficiency, becoming more efficient. And first half, you notice this is not just one-off. It's an ongoing process. During the first half of 2016, the company completed, this is the output, and then it achieved revenue of 10.6 billion first half. So first half revenue, I think, would be more or less the same as last year, because second half, assuming they they will record another 10 billion or so revenue, so it will come in around 21 billion. Last year is around 20 billion. So revenue more or less the same, or an increase of not more than 10%. But the bottom line, very impressive. Net profit attributable to shareholders increased 2.4 times to 939 million RMB. I showed you just now, for the full year 2015, they made 10 billion. But this year, just for half year, they made 900 odd million. So full year, I think their net profit will increase to very likely 1.8 billion, 1.8 billion, or close to 2 billion. That would double last year's 1 billion. Okay, so why is this? Why does this happen? It's because the company boosted production efficiency through measures such as adjusting product structure, upgrading production process, expanding overseas sales, and raising selling prices. So they have done a lot, put in a lot of effort to enhance their profitability. And they aimed at a higher market share of high value added products by developing competitive products such as wine label, paper for wine label put on the bottles, the wine bottles, and logistics label and liquid packaging paper. Okay. And they also have a few ongoing projects, new projects that will boost the future production output and also capacity. One is located in Zhanjiang. Zhanjiang is near Guangdong, Hainan Island. Zhanjiang means 600,000 ton liquid packaging paper project. This project has entered the equipment installation and calibration stage, and the trial operation has commenced end of August. So they will add another 600,000 ton of capacity. And then the company also actively pushes other projects such as Haiming's mining project, Guanggang Chenming's integrated forestry pulp and paper project, and Shouguang Meilun's 400,000 ton chemical pulp project. I also wish to point out to you one key difference of this company, Chenming, with compared to the other two paper manufacturers, Jiulong and Liwen, is its business model. It's vertical integrated business model. That means it operates and owns its own forestry plantation. Because you know paper are made from wood, wood pulp, and then they have their own pulp factory to turn the wood into pulp, and then finally they make the pulp into paper. So they operate this vertical integration on a vertical integration model. And if they operate well with an integrated vertical operation, the profit margin tends to be higher, much higher, because the raw material, you make it yourself. You don't need to buy procure from outside raw material, so we can control the cost at every level. Okay, and the long-term prospect of China's paper making industry is also brightening because oversupply has been reversed, attributable to efforts to reduce excess capacity and inventories. And in the medium to long run, the supply side reform and higher environmental protection standards will accelerate the phasing out of small and medium-sized players, further enhancing industry concentration. And that would benefit the big players. Because, paper manufacturing is very polluting, will pollute the water resources. So China now, because of the pollution getting more serious, they are imposing more stringent environmental protection standard on the paper making industry. So a lot of small and medium-sized players, they cannot satisfy the new standard, the higher standard, they will be eliminated. So this will benefit the big players. That means competition will be reduced. Okay, the share price also actually reflects it's pricing in. I won't say that it's undervalued. It's pricing in the profits, the earnings growth, but it's still cheap because it's trading at around 12 times historical PE, whereas Jiulong and Liwen are trading at higher, close to 20 times historical PE. And then 12 times historical PE was based on the earnings last year. Last year, it earned 10 billion. Am I right? This year, first half, they already earned 939 million. So for the full year 2016, it's very likely the earnings will double. And then the earning per share, last year is 50 yuan, 50 fund. So by making this year, it may make 90 fund to be more conservative. We don't estimate as much as one yuan, just 90 fund. The share price is around 740 Hong Kong dollars. So with an EPS of 90 fund, that's more than $1 Hong Kong dollars. That means the forward PE for 2016 will be single digit. Am I right? It will be around 7 times. Is it cheap? And then the yield is yielding 4.8%. So the yield is also attractive. PE, it drops to single digit if it manages to double its earnings again this year compared to last year. So despite the rally, it's still attractive. Okay, one more company to recommend. This is one of the constituents of the Hang Seng small cap stocks. Because after the launch of the Shenzhen Hong Kong Stock Connect, what are the companies that Chinese investors will be interested? Or they can buy? This may be one of the companies because it's a constituent stocks of the Hang Seng Small Cap Index. The company, why we like this company is because it's one of the largest private hospital groups in the PRC, comprising 16 medical institutions with approximately 5,780 beds in operation in Beijing, Tianjin, or Hebei, owned or operated by the company, including 3 Grade 3 hospitals, 6 Grade 2 hospitals, and 9 Grade 1 hospitals. And also it has, it all adds up to 18 hospitals, but it has 60 medical institutions. So the rest are clinics, hospitals and clinics. So it is one of the largest private-owned hospital groups. And then for your information, the hospitals in China, they are categorized in 3 grades, 3 types of hospitals. Grade 3, Grade 2, and Grade 1. But normally Grade 1 is the highest, 1, 2, 3. But in China, the classification is Grade 3 is the highest level level hospital that can provide all a comprehensive range of healthcare services, such as primary preventive care and acute care. They can provide intensive care. So grade 3 level hospitals are the highest level, and then grade 2 and the lowest level is grade 1. And they have this model of self-owned. So they own 2 hospitals. Their revenue is derived from in-network hospitals and clinics through 3 sources. The general hospital services provided at 2 of the hospitals directly owned by them. So they own 2 hospitals, and the rest is managed by them. It's owned by other, they have a separate owner. But like hotels, because they have the goodwill, they have the brand name, and also they have the expertise. So owners of those hospitals give the management power. Let them manage their hospitals. So the revenue is derived from hospital management services, where it manages and collects management fees from its IoT hospitals and clinics. Or some clinics are also not owned by them, but managed by them. So this is the asset-light model that it is adopting. And then third source of revenue comes from supply chain business, because it operates 60 medical institutions, including hospitals and clinics. And then by providing the necessary pharmaceuticals, medical devices, medical consumables, and ancillary services, it derives the revenue from this supply chain business. So this is the revenue model. IoT is managed by them, hospitals managed by them. Okay. Now, this is a chart showing the number of beds. So they have 5,780 beds in total, and also the patient visits total more than 1 million last year. So you see steady growth in both number of beds as well as patient visits, annual patient visits. But it does not stop there. First of all, let's look at the financial results of the company. But it recorded revenue of 7 million renminbi yuan in the first half, representing an increase of 17.1% from the same period in 2015. Net profit attributable to shareholders increased 28.2% to 130 million yuan. So the net profit increased faster than the revenue due to an enhancement in the gross profit margin, the GP margin increasing from 23.5% to 25.8%. So we can see the also the enhancement in profitability of the company. But what we are upbeat about this company is it has entered into agreement with 2 very big players, China Resources Healthcare Group and CITIC Medical and Healthcare Group, both being wholly owned subsidiaries of state-owned enterprises. China Resources is Huarun. Huarun 集团 is a Yangqi, one of the largest Yangqi, 中央企业. CITIC is Zhongxin. So both state-owned enterprise, they sell their assets, their hospital assets to this Phoenix Healthcare. The assets include 49 medical institutions, including 6 grade 3 hospitals and 6 grade 2 hospitals, 25 grade 1 hospitals, and 12 community healthcare centers and 3 elderly care institutions. So by acquiring these assets, actually Phoenix does not pay any cash. It will issue new shares to the seller. It's actually a reverse backdoor listing of the state-owned enterprise. After the launch, you can see the benefits to Phoenix Healthcare. As I mentioned just now, its current hospital network focuses more on the northern part of China, only Beijing, Tianjin, and Hebei. This is the area, this area. Beijing, Baoding is Hebei, and also Shunyi, Beijing, Fengshan, this area is operating. But the acquisition of those assets from CR, China Resources, and CITIC will significantly expand the geographical coverage of its hospital network to a nationwide coverage. These are all added. The white one represents the hospitals owned by CR Healthcare. So it has hospitals in Yunnan province, in Kunming, also in Huaibei, Wuhan, central part of China, and Hangzhou, the coastal cities of China, Changsha, and then Guangzhou. It will help enable its hospital network to extend to the southern part of China. Okay, and also it will become one of the largest healthcare services groups in Asia with 109 medical institutions, because they have 49, they buy 49 at the current, they own 60. So 60 plus 49 add up 109 medical institutions, including 12 grade 3 hospitals. Currently, there are only 3. So after the acquisition, they will have 12 grade 3 hospitals. And the number of beds are more impressive. I pointed out to you just now, it owns 5,780 beds. But after the acquisition, the total number of beds will increase to 12,600 beds. And then over 10 million annual patient visits, doubling its previous scale. So it would be a big jump in capacity, operation capacity for the company. Because it's issuing new shares to China Resources and CITIC Medical Healthcare Group, so China Resources Healthcare Group will become a controlling shareholder of the company, bringing about a strategic transformation of the company from a private institution to a public-private partnership, mixed ownership institution. I think a lot of investors are still very concerned about investing private enterprises, Chinese private enterprises, because of the corporate governance and also the management. But after the acquisition, this CR, China Resources, will become the controlling shareholder of Phoenix Healthcare. So it will, corporate governance-wise, and also the management will be strengthened because of the inclusion of a state-owned enterprise as the major shareholder. The acquisition will also establish a national healthcare platform to promote the sharing of resources and lower the procurement costs through economies of scale. So a lot of procurement going forward, procurement of pharmaceuticals and medical devices, they can do it in a bigger scale. So they can be able to lower, they have more bargaining power with the suppliers. And then the integration of resources will further advance the expansion into industry chains, including elderly care and insurance. Just now I mentioned, currently they all only operate hospitals, no elderly institutions. But Huarun CR Healthcare Group, they have three elderly institutions, 300 beds. They will inject it, sell it to Phoenix Healthcare. This is one area that is fast-growing area in China. You heard a lot about China's aging population. So aging population implies that there's more demand for healthcare. That's for sure. Healthcare, and also more demand for elderly care. And then the elderly institutions run by China Resource is different from the ordinary elderly homes because it's a combination of elderly care and healthcare. They provide the doctors and the nurses in the elderly home. So it will be more attractive, more appealing to people who can afford better quality, better service, hospitals as well as better quality elderly care. So this will be the growing growth driver for Phoenix Healthcare in future. Share price, it went up to about 16 Hong Kong dollars. It doesn't have any A share. It's only listed in Hong Kong. So it went down to below $6. And actually, after the announcement of the acquisition was announced in April this year. So its share price kept up because of the transformation, also the expansion of the assets. And then it holds well about $10. Now it's trading around $13.50. So if there's any correction to below $12, we think it's a good entry level. Below $12. And if it so happens that we have to play safe, set a stop loss price at $10. If it drops below $10, we have to stop loss. And then if we manage to buy below $12, our target would be we expect it to retest the $16 levels in the medium term. $16, $12, around $12, recommend buy. $16 is the target price. Cut loss at $10 or below. Okay, so that what I wish to share with all of you here, and also the company that we are interested in. Finally, this is one service that we wish to introduce to you. It's our Philip Managed Account Services provided by Philip Capital. They have different market focus. So they also have the Hong Kong, China focused managed account. So for investors, Singapore investors, if they don't have the time and also not familiar with the Hong Kong and China market, actually they can may as well try the managed account service provided by Philip Capital. And their managed account service work very closely with our Hong Kong managed account team, which is overseen by me. So they will mirror the portfolio, the stock picks of our Hong Kong managed account portfolios. So there's a mirroring and also the stock selection. And sometimes when we do company visits, we do together. We visit the management. Most of the stocks that we have invested will do very comprehensive, thorough company visits and management discussion before we decide to so-called pull the trigger to invest in the stocks. So if you are interested in this service, you can call our colleague here. The number is 6531-1555, or write an email to them. The email address is maenquiries@philip.com.sg. Okay, so that ends my presentation.